Options trading can be a great way to grow your income, limit your risk, and hedge against market fluctuations all at the same time. For these reasons, options can be complementary to stocks in your portfolio. This gives you more possibilities, more incomes than just trading stocks alone. Options can also lower your break-even point and potentially let you pick up a stock below its market value. Despite its popularity around options trading, this is not a straightforward strategy. In reality, it can be quite complicated and need to be tactical if you do want to get involved. So make sure you watch the full video so you can get an understanding on how you can get started with options trading. And before you can get started with options trading, you need to understand what are options in the first place. An option is basically a contract giving you, the investor, the right or the option, but not the obligation to buy or sell a stock or ETF at a specified price or a specified period that can range from days to years. Now, if you want to use fancy financial lingo, the specified price is also referred to as the strike price. Unlike shares of a stock, an option does not represent ownership in the underlying company. Because it's a contract, it represents the potential for an ownership, but the option must be exercised for that to happen. Before trading options, you need to understand all the lingo involved, and that means understanding the two varieties of options, calls and the puts. A call option gives the holder or the buyer the right to buy a specified number of shares, usually 100, of a stock or ETF at the strike price at any time until the contract expires. Put options, on the other hand, gives the holder the right to sell a specified number of shares of a stock or ETF at the strike price at any time until the contract expires. This was just a basic explainer of options, but getting involved also means understanding the different long and short positions an investor can potentially take. While a stock position can be held for a very long time or indefinitely, all options eventually expire. As the expiration date approaches, options generally lose value and can end up being worthless. Whether you choose a call option, a put option, and whether you decide to buy or sell ultimately depends on you, what your objectives are as the options trader. And trust me, it's never a good idea to just blindly pick an option for your portfolio without doing the research first. And watching this video to get an understanding of how options trading works is a step in the right direction. When it comes to options trading, you also need to understand how to read an options quote. This is much different than reading a quote on a ticker symbol for a regular stock. And stock option quotes are listed on market exchanges around the world, like the New York Stock Exchange, for example. And each stock quote contains multiple different parts, so you need to understand how each of those parts works. Now let's take a look at what makes up each stock option quote. The first is the stock symbol. This is the asset that is attached to the options contract. The next is your strike price. This is the price of exercising the option. Next is the type of option. This is a type of option that is specified, for example, a call option. Next, you have your expiration date. This is the date which the option will expire. And then finally, you have your premium. This is the cost to buy the overall options contract, and it's listed at the very end. Now that you know the parts that make up a stock options quote, let's take a look at an example. So here we have XYZ, December 17, 2021, 70, call at 3:10. Let's see what this means. First, XYZ, that is a stock option that it's based on, and it usually represents 100 shares. Next is your date. This is the option's expiration date, the last date to trade this option. Right after that, you have the strike price. In this case, the stock will change hands at $70 if the option is exercised. Next, you have the two types of options, either a call or a put. In this case, we have a call option. Last, you have the premium or per share cost of the option. And this options contract usually represents 100 shares of the underlying stock. In this case, you'll pay $310 plus commissions for this contract, which breaks down into $3.10 times 100 shares. By the way, if you're new to the channel, you've seen my content before, do me a huge favor, hit that like and subscribe button. It lets me know to produce more content like this, and you don't miss out on future videos. When you buy a put option, you're essentially buying a contract that gives you the option to sell a security by a certain expiration date at a certain price point. And before you buy a put option, there are certain factors that you need to consider. 1, how much do you want to invest? 2, what is the time frame that you want to invest for? And 3, the anticipated price movement of the underlying asset. Buying put options makes sense if you think the price of an asset will go down before the expiration date. If you buy a put option at one strike price, then the asset value goes down to another price. You can exercise your option at the original strike price. Let's take a look at an example. Let's say you buy a put option for 100 shares of ABC Corp at $50 per share. Prior to the expiration date, the stock price drops to $25 a share. If you choose to exercise your option, you can still sell the 100 shares of the stock at the higher $50 per share price. Buying a call option means you're buying a contract that gives you the option to buy a stock or security by a certain expiration point. When buying call options, it's no different than the factors you would consider than buying a put option. Buying a call option makes sense if you believe the price of the underlying asset is going to go up by the expiration date. Let's take a look at an example. Let's say you buy a call option for 100 shares of ABC stock, only this time you're hoping for a price increase. Your call option contract gives you the right to buy the shares at $50 each. Meanwhile, the stock price climbs to $100 a piece. You can now use that call option to buy that same stock at a massive discount. So in a nutshell, if you believe the price of an asset is going to go up by an expiration date, maybe buy call options. But if you believe the price of an asset is going to go down by the expiration date, then buying put options makes sense. And overall, what is the best way to keep track of your stock portfolio so you can see which stock is going to go up or down? You can download my custom-built portfolio spreadsheet that I developed from the ground up for investors like you. You can keep track of things like price movements, dividend income, gains, losses, and much, much more. I would not be able to manage or grow my portfolio without the spreadsheet, so make sure you download yourself a copy. Check out the link in the description and get yourself a copy today. So far we've talked about what is options trading, how to read an options code. Let's talk about how risky is this strategy. You might hear from those that are trying to sell you an options trading course that it's quite simple and you can make a ton of money. And they're saying this because they actually make a ton of money by selling you the course. And because I'm not here to sell you any course, I can tell you the unfiltered truth. Options trading is known to be quite risky, and that's because of how complex it can be to understand. That's why it's so crucial you, the investor, understand how option trading works before you get involved. Investing your money into something you don't really understand is never a smart financial move. And the entire goal of this channel is to help you better understand the world of personal finance. The risk you take on as an options investor depends on the role you take on in the contract. Meaning, what side of the options contract are you on? Are you the buyer or are you the seller? And also, what is your strategy and what are your investment objectives? There are multiple strategies you can implement using different combinations of options. The options market offers both a bullish and bearish strategies, hedging and speculative trading opportunities, and varying degrees of potential for risk and profit. Option strategies may be based on time value, volatility, and even interest rates. You might be feeling a little bit lost right now with all this financial jargon, and if so, you are on the right track. As I said earlier in the video, options trading is not a simple strategy, nor was it ever meant to be. It takes time to understand, and the more you learn and understand, the better you will be. Because options trading involves substantial amount of risk, you'll find that brokerages will implement certain criteria and requirements for investors to meet before they can get started with options trading. Now, as a caveat to all this, not every single option strategy is super complicated or super risky. There are some basic strategies that are relatively straightforward and can provide an effective way for investors to generate income or hedge against risk. And later in the video, I'll go over these basic strategies so you can get an idea of how they actually work. Like all investment choices, you need to have a clear understanding and idea of what you want to accomplish as the investor, or in this case, the options trader. Let's take a look at an example with two different investors who are just getting started with options trading. Investor A decides to get started with options trading because he wants to generate more income from the stocks he already owns. Investor B, on the other hand, wants to start options trading because she wants to protect her stocks from a market downturn. These are two different objectives and requires two different strategies to reach those goals. So what do the strategies actually look like? Investor A might consider a strategy that's called writing covered call options, which basically means selling someone else the right to purchase a stock he already owns at a specific price and time frame. Investor B, on the other hand, might consider a strategy that involves purchasing put or options on an index that tracks the type of stock she owns in her portfolio. So far, I've talked about the basic of call options and put options, and we've even taken a look at covered call options. There are two other strategies that you can potentially consider. One is called a married put strategy. This involves purchasing an asset and purchasing put options for the same number of shares. This approach gives you a measure of downside protection by allowing you the right to sell at the strike price. Another strategy is a long straddle strategy. A long straddle strategy involves buying both a call and a put option on the same asset at the same strike price, at the same expiration date, at the same time. This approach is often used when an investor is not sure which way the underlying asset's price is going to move. Is it going to go up? Is it going to go down? So it's a way to hedge against that price movement. Is options trading for you? When you're ready to start trading options, you need to choose a broker that options you a low per contract fee for options, as well as the research and tools that can guide you along the way to help you choose the most effective strategy. Hopefully now you can make an easier decision whether options trading makes sense for you or not. Now, you may feel eager to jump on the options bandwagon based on the flashy videos you watch, whether it's on YouTube, Instagram, or TikTok. The most important takeaway is that you need to understand what you're getting into before you get involved, because no one will care more about your money than you will. So arm yourself with the knowledge and make the right choice. Thank you so much for watching. Make sure to check out the links in the description of this video so you can support this content and future content. And I'll talk to you in the comments section.